Hi, everyone. This is Jason Burek of Wall Street from E Street. Welcome back to another Wall Street from E Street podcast interview. Today's special guest is a first-time guest, but I've been watching his interviews for years. He runs one of the oldest, if not the oldest, gold stock newsletter, Gold and Gold Stock newsletter. It was first started by Jim Blanchard in 1971. He took over as editor in 1993. And he's also the host of the famous New Orleans Investment Conference, which has a ton of really great special guests. A lot of my friends go there and speak. Brien Lundin, thank you for joining me.
Great to be with you, Jason. Thanks so much for the opportunity.
So, Brien, we're recording this interview on Tuesday, March 19th, 2024. The gold price has had a substantial rally the last couple months. A couple months ago, looked like maybe gold was going to maybe crash, but then it's since rallied. I think a lot of it's on this big spike in Chinese gold demand. The gold price to 21.57. The silver price was up to around 25. It's down to $24.85. I want to get your thoughts on the macro conditions first. All the craziness going on, the U.S. federal government budget deficits. Do you think that we're going to see a lot more debt and inflation going forward?
I'm not quite so sure about inflation. I think inflation is going to come in waves. Yes, we are going to have higher inflation down the road, but we'll have it fall back a little bit as well. I don't think that we're going to get down to the Fed's target of 2% long term. There's just too much that's embedded in the calculations right now. So they will fail on that. But I don't know that that's the primary motivating factor or dynamic driving the metals prices right now. Weirdly, these days, higher inflation numbers are perceived as bearish for the metals because they imply a tightened Federal Reserve monetary policy. So if inflation numbers come in hot, used to be in the 70s, that would be bullish for gold. But these days, because everything depends upon Fed monetary policy, because every asset market, stocks, bonds, commodities, gold, silver, real estate, everything is so dependent on Fed monetary policy after over 4 decades of ever easier money, then everything is interpreted from that point of view. So, everything's correlated. All these investments, asset classes that used to be inversely correlated, everything's positively correlated with each other now, and it all depends on what the Fed is going to do. So, higher inflation, I think we're going to see it. I don't think that's going to be necessarily bullish for gold. But I think everything is going to be overwhelmed. All of the other trends, all the other factors are going to be overwhelmed by the simple fact that we have so much debt that has been built up after decades of ever easier money. The federal debt in particular is still resetting at higher rates. And it's already at $1 trillion a year in just debt service costs for the federal debt and rising rapidly. We have nearly $1 trillion in commercial real estate debt that's resetting this year at much higher rates. Now, Jason, you might remember that when we were still in a zeroed interest rate regime, we had about 20% of U.S. companies that were essentially zombie companies, barely able to make to service their debt, make enough money to service their debt, when the interest rate regime was near zero. When those debts reset at higher interest rates, we're going to see those zombie companies falling one by one. And that, I think, is a primary factor that will be driving us toward recession. So the big issue, I think, for precious metals and really all markets is that the Fed will be forced to cut rates. They will be forced to pivot. And gold in particular gained about $400 during this hiking period, during what was arguably the harshest Fed rate hiking period ever. Gold gained about $400. So when those headwinds convert to tailwinds, when we get on the downside of the cycle and the Fed starts to cut rates, I expect gold to do even better, considerably better. And that puts us at much, much higher gold prices than what we're seeing today.
think you made some interesting points there about the lag effects of the Fed keeping rates at these levels. It's not sustainable for government spending, although the people in DC, both political parties in Congress and the White House, they seem perfectly fine with adding $1 trillion of new debt every 100 days and the new Biden 2025 fiscal budget. And Congress seems to be on board with it for the most part. I guess they're fighting over a few things here or there, but no one's talking about really big spending cuts. The Biden 2025 fiscal budget is projecting a 1.8 trillion budget deficit, but there's like some really ridiculous assumptions in there. Before we started recording, they're just assuming that they can increase tax revenues by another $1 trillion magically.
Yeah, they're ridiculous assumptions. Now, keep in mind that all of these people in Washington, regardless of what happens, they're still going to get paid. Also consider that they've never run a lemonade stand, so they have no conception of that, of the dynamism of tax policy. That if you raise rates, you're going to get more tax avoidance, and you're going to push down in one area and it's going to come back in another. So they may and probably will actually see lower tax revenues as a result of raising rates. And it's all of this, pulling the levers on the economy and thinking you can manage such a complex system with all of your PhDs. It's ridiculous. It's the kind of hubris that's been proven wrong over and over again, but they're going to do it because that's what they do.
Exactly. To the point about people in Congress in DC, they haven't run real businesses, although apparently now there's a lot of good hedge fund managers there because a lot of them, dozens and dozens of them, not just Nancy Pelosi, they're outperforming the S&P 500 with their stock trades.
Yeah, there's somebody does an Nancy Pelosi index or trades out there, and it's just performing spectacularly well. Although not as well as Nancy's own portfolio, because by the time we learn what she's invested in, it's already moved. Because she, of course, is learning about what to invest in well before it moves. But yeah, if you look down at all the politicians, you look at their annual salaries and what they were worth before they went into office, and the tens, if not hundreds of millions of dollars that they're worth today, it's as plain as day. The kind of political regime we live under. And again, what we're seeing are trends that have been in place for decades, ever since the guns and butter deficit spending of the 1960s. And we're in the end game of that process, that trend right now. Whether we're going to see another boom bust cycle or the one after that, we are in the end game, and debts are too large right now to handle, and we're going to be adding to those debts at an accelerated pace and forcing the dollar and other fiat currencies around the world to devalue as a result. So it's something that's going to demand a reset at some point, and I don't know whether that's 3, 10, or 15 years in the future, but my thesis is that whatever lies ahead, you're going to want to own gold and silver and associated investments going into it.
And we were talking before we started recording, a lot of the waste, fraud, corruption, and abuse here in DC with the budget deficits, the negative return on investment or return on investment at zero for these green energy projects. It's very similar to end of empire behavior from a lot of different governments, whether those are Chinese dynasties with paper money, the Roman Empire, British Empire. It's classical end of empire behavior. Reminds me a lot of reading about the Roman Senate, how corrupt the Roman Senate had become. Congress is very similar to that. I mean, the technology is better. They're trading stock options. They're trading on their phone. They're doing crypto trades. But the levels of corruption, history is definitely rhyming.
Yeah, it does rhyme. In some of my presentations that I give, especially on why someone should invest in gold, because I'm giving a lot of presentations, I have given a lot of presentations over the last few years to people who are new to the sector. And I featured 2 successive slides in my presentation, one showing the decline in the purchasing power of the Roman denarius over about 60 years. And then I juxtaposed that with the decline in the purchasing power of the US dollar since the 1960s. And they're virtually identical. Now, if you look at the history of the denarius's devaluation during the Roman Empire, you see that it does progress for some time, well over 100 years, before you really get to see the kind of conflict that with the collapse of the Roman Empire. But the parallel to today is striking. I think there are some big differences, obviously, but it is a cause for worry. And if you look back then at, say, some of the writings of Cicero during the later days of the Roman Republic before the empire, it mirrors a lot of what people are saying today, like what you and I are saying right now, perhaps not as eloquently, but they are the same concerns. And this gets to the larger point that I make over and over again, have been making for years, is that what we're fighting here, or what we're seeing here, is human nature, which never really changes. The people that were walking around in togas in the Roman Senate, the people walking around in ancient Greece were as smart as we are today and as sophisticated as we are today, and had the same problems and the same issues. And in particular, those governments, and every government throughout human history, overspent their means. They went to excess, whether it was from entitlements, which were prominent in the Roman Empire, to military campaigns, to outright corruption, and despots and dictatorships and the like. They always overspent their means, and they were always forced to devalue the currency. And that's what we're seeing today. We're seeing the same process play out, not just in the US, but through all the developed nations on the planet today. And all of those fiat currencies are racing to the bottom of the hill at the same time. They're all devaluing against things, against physical, tangible assets, against gold and silver and other commodities. And that's going to continue. And like I say, at some point, it's going to demand a reset, because no currency regime has ever, they've all failed at some point. When that will happen in this currency regime, and that's not just the dollar, but including all the other fiat currencies, that remains in question. But the trend is obvious, and that trend is accelerating, and that means that things are going to appreciate versus these fiat currencies, most prominently gold and silver.
Do you think that there's a growing supply and demand imbalance in the U.S. Treasury market, meaning that DC, the federal government here, wants to sell way more Treasury supply than there's a foreign demand for?
Yeah, they have to float a lot more. But well, just what we've been talking about, the increase in the deficit, the increase in the debt service expense, just the interest in the federal debt has soared past $1 trillion a year. Where are they going to get that money? Well, that's another $1 trillion of Treasury securities that have to be floated onto the market to pay just the interest on the federal debt. So we really are in a debt spiral. And yes, the Fed is going to have to continue to not only roll over all of the shorter term debt, which is the vast majority of the debt, but also float new debt to pay for interest expense and further deficit spending. The question then is, with the Fed being forced at some point to cut rates, either because the economy is slowing down or we're getting into recession, or simply because the cost of servicing the federal debt is growing so high at these interest rates, or some other crisis or conflict, they will have to cut rates, and will try to cut rates. But by the same token, with so much more treasuries being floated onto the market, at some point, those buying those treasuries are going to demand higher yields for the greater risk that they're having to face. In other words, the bond vigilantes. We saw them surface last October, November, very briefly, when they drove the 10-year yield up toward 5%. So we have these two opposing forces, the Fed that will want to lower rates and the bond vigilantes, the buyers, the free market buyers of those treasuries demanding higher yields. That will be a real battle royale, as it were. I think that the Fed will be able to win, at least in the short term, by swamping the market with treasuries and buying most of them itself to force rates lower. But that, again, just exacerbates the problem.
And the Congressional Budget Office, I think in the Biden 2025 fiscal budget projections, is estimating that the national debt will grow to another 10 trillion over the next decade. I think that could happen a lot faster than people expect, especially if there's bailouts for these regional banks, commercial real estate. I mean, there's a lot of problems coming, Brien, in the next couple of years. I don't know if commercial real estate crisis is in 6 months, 12 months, next couple of years ago, over the next 2 years, though, there's a lot of commercial real estate mortgage debt that has to be reset at much higher rates.
Yeah, and it will. And there's some doubt that it will be reset at higher rates because those banks are not just going to automatically roll them over at in the current interest rate regime. They're going to also look at the collateral behind behind that debt. And if that collateral is 15, 20 or more percent lower and falling, then some of that debt won't be rewritten, or at least not anywhere near the current interest rate. So it's a tsunami. Just the commercial debt is a tsunami off the shores of the U.S. economy that is going to hit over the months just ahead. We know it is. It's a matter of simple math. It's not a matter of any brilliant prognostication or forecast. It's just simple math. This will happen. And that alone is enough to force the Fed to pivot, or at least try to pivot.
So for non-G7 central bank gold demand increases, do you think that the majority of the increases have started to rapidly increase after the Russia sanctions, or do you think that there's other reasons for that?
Yeah, there are a lot of reasons. The U.S. has adopted or weaponized the dollar. And what we're seeing, we are beginning to see some effects from that. Now, a lot of people predict that the dollar will lose its status as the global reserve currency, and in fairly quick fashion. I really don't agree with that. I think that the most important factor in the dollar's favor as the global reserve currency is the rule of law. And we certainly have lots of reasons to criticize the rule of law in the U.S., but it still is the best out there. It's better than investors and sovereign investors and private investors will see in Russia or China or any other competitor to the U.S. In the global reserve currency. So I think we are going to see the dollar maintain its status for some time to come. And for as long as it really, is relevant to our personal timeframes and investing timeframes. On the other hand, though, what that dollar weaponization has done is it has led other countries to try and insulate them from that influence, and they're buying gold to do so. So it's really led to an increase in sovereign gold purchases, and that's been very significant for the gold market right now. It's created a bid, and importantly, a price-insensitive bid below the gold market that has led, the shorts and the bears to walk away in frustration. So that's really important. That's the most significant impact of this dollar weaponization by the U.S. in the short term.
Yeah, I think there's two main factors that have increased gold demand. The one is there was central bank purchases of gold tonnage prior to the Russia sanctions, but it seems that things really picked up pace. The acceleration really increased in terms of tonnage purchases after that event within a couple months.
Yeah, 2022 saw a record amount of central bank gold purchases, and then 2023 saw nearly the same amount, not quite as much, but still very high levels of gold purchases. And this year, it seems like we may set a new record. We're just getting anecdotal reports at this point, but and a few countries have reported on a quarterly basis. But it looks like another big year for central bank gold purchases.
I think the People's Bank of China, and they normally don't release a lot of stuff publicly. I think there's been 16 months in a row of net tonnage increases. So that's pretty rare for them to do that. And I think the writing's on the wall there that all these other countries, because if Trump wins the next election, I mean, he's talked about sanctions on China. So they're saying, well, we're not going to buy a lot of US treasuries. We're going to start diversifying away. We're going to buy more gold.
Yeah, they are. They will. And they are increasingly switching toward gold as opposed to U.S. treasuries. And of course, Russia had completely traded in its treasuries for gold long ago, a few years ago. And it is increasing. And Russia still is a fairly large gold producer. And I would imagine that not much of that gold is making it out of the country, since the central bank can print all the rubles it wants to buy that gold production in Russia itself. So we don't know exactly what they're doing, but I would imagine that they're also increasing their gold reserves.
Is this the most in terms of increases for private sector demand for China, India, Turkey, other emerging market countries that you've seen since you've been covering gold stocks?
Yeah, absolutely. And keep in mind that it only flipped. I'm trying to remember about 2010 or 2012 or thereabouts, that central banks flipped from being net gold sellers to net gold purchasers. And it started after the 2008 great financial crisis, that central banks decided to actually buy gold. And I don't know that it was part of a well thought out strategy. I think it's more of a general unease with the direction that, frankly, their policies have taken the global economy. So who better to know when they're screwing up than themselves? And they have increasingly, and 2013 was a really big year for Chinese gold purchases as well. So it has been an accelerating trend. And interestingly, we're also seeing the ratio of central bank or sovereign gold reserves shift from west to east, that Asian central banks are buying more gold and controlling more gold to a greater and greater degree.
And the data backs that up with the outflows for GLD and SLV, especially GLD, because there's been a lot of net outflows. I think the demand for gold, it's not really from US and Canadian. Now, there's some demand at Costco for some bars, but if you talk to a lot of bullion dealers, I mean, they have a lot of inventory here in the US and Canada. A lot of US and Canadian investors, they seem more interested in chasing Bitcoin, chasing tech stocks, day trading, trying to get rich quick on a lot of these technology stocks or crypto instead of buying physical gold.
It really is interesting. And I've been talking about this for the last few months, that the supply demand dynamics at work in the gold market right now are very interesting and unique in my experience, in that we have a rising gold price setting new records, but with Western investors seemingly completely absent. If you use the holdings in the GLD ETF as a proxy for Western gold demand, we see that those holdings have been falling off a cliff, even as the gold price has been setting new records, which is, very interesting and contrary to history, because typically Western investors are trend followers. They follow the price up. As the price rises, they buy more. Asian investors, in contrast, are bargain hunters. They typically buy on price declines. Yet now we're seeing a lot of buying coming from Asia. We're seeing central banks buying strongly, and Western investors largely out of the market. Now, with that said, we have seen open interest on the COMEX rise as the price has risen. So that's showing some growing demand, at least in the paper gold market, as it were. But those are largely traders, or more fast money buyers that are to some degree buying more gold or shorting more gold as the price goes up. Bloomberg had an interesting piece out today as we speak, suggesting that the fall off in GLD holdings may actually be big investors either taking delivery off GLD, and those big investors possibly being central banks, and essentially buying their gold off of GLD. Another way to do that, they could simply sell GLD and then use the proceeds to buy gold in other markets, because sometimes it is actually a bit convoluted to actually take possession of gold off of GLD. So in effect, the falling holdings in GLD may just reflect a shifting of gold ownership from west to east, and that it is, instead of just a proxy of Western demand, it is more of a vehicle for supplying gold to the east.
Well, when gold prices in US dollars were below 2000, I mean, there was an arbitrage for a bullion bank that was a custodian of GLD. They could have pulled the metal out of GLD and then shipped it to Asia and collected enormous premiums in Shanghai because it was selling for around $2,200 an ounce.
Yeah, that's true. And whereas the premium in Shanghai has fallen a good bit, it's still relatively high. I don't know if it makes sense to ship that gold, but again, if you already own a position in GLD, you can sell it there, and buy it somewhere else and then ship it to Shanghai. There is something going on, and it is a flow of gold, in this case, from west to east on a rising gold price. That's really the unusual thing about the market right now. Usually as the price rises, the gold flows from east to west. That flow has reversed on a rising price. The implication of all of this is that once the Western investors do hop on board as trend following investors and speculators, then that would be the first time in my experience that we would see Western investors and Eastern savers and investors buying at the same time. And importantly, also price insensitive central banks buying as well.
The macro factors, Brien, they actually kind of remind me of studying the 6 to 12 months prior to the October 1929 crash, because a lot of people may not have studied that, but a lot of the other major economies back then were in recession or depression. There was tons of flight capital that came into the US. There was a commercial real estate bubble prior to the October 1929 crash. I believe the Empire State Building and other major skyscrapers went unfinished for years after the October 1929 crash. And then there was also a technology bubble. So there was tons of flight capital that was coming into the US. A lot of the macro factors, the cross currents going on, it kind of reminds me from around 100 years ago, very similar to now, that there's a ton of hot money that's come into short-term US treasuries. It's come into tech stocks. But then the foreigners who are not buying those things are also hedging in their own currencies, because their own economies, their domestic ones like China or others or European Union, are already in a recession or depression. So they're starting to worry about currency debasement, and they're hedging with gold.
Yeah, and I think it's an example. You're right, there are a lot of parallels, but it's an example of how a deflation or depression can erupt when you have a destruction of capital, when these bubbles burst. So that may happen, obviously, because the U.S. and really global stock markets are so overextended right now. We could see that burst, and we could see that kind of deflationary impact. But what happens when you have that kind? I'm not really afraid of deflation like a lot of people are, because I know that when we have those whiffs of deflation, the central banks are just going to step up their money printing and their accommodative policies, and they're going to come in and really blow your socks off with what they'll do this time in trying to refloat the economy. And that will be bullish for gold. The reaction to the late 20s and that stock market crash and the resulting depression was that the Treasury, the FDR, had to devalue the dollar. To do that, he thought he had to confiscate all of the gold of American citizens, which he did. And then after he had taken everyone's life jackets and lifeboats, he drove the Titanic into the iceberg by devaluing the dollar by 69%. Again, having already taken everyone's gold and not removing their ability to protect themselves from that policy shift. So we could have something similar happen. Not a gold confiscation, although I wouldn't rule it out. I don't think it's likely this time around, given how widely gold is owned, even sold by the U.S. government. And I think that would be a step too far for the government to try to do in this case. But a dollar devaluation and general fiat currency devaluation around the world against the benchmarks like gold and other tangible assets, I think that's absolutely inevitable.
I think the U.S. federal government, the Federal Reserve Bank, Treasury, they're more focused on asset price inflation, making sure the S&P 500 doesn't stay low for more than 6 months, making sure home prices don't stay low for more than 6 months, because they need those tax receipts, the U.S. federal government tax receipts, and then the state and local government for the property taxes. Their tax collection has shifted the last couple decades, so via asset price inflation.
Yeah, and of course that was the big goal of support of the stock market post 2008 is the wealth effect, and if people feel wealthy because their stock portfolios are doing well, then they're going to spend more money. And all of modern economic theory is built upon the foundation of aggregate demand, and being able to pull those levers as government to increase or decrease aggregate demand.
Yeah, so you mentioned deflation. I think the rules changed after 2008. They realized with the total size of the debt, and it's only grown, and then the derivatives market, the banking system with fractional reserve banking, I think they realized that they can't allow deflation for a long period of time after 2008. So I think they will have to step in at some point. I don't know if it's going to be Fed balance sheet expansion, currency debasement, a combination of those things, lying about the Fed's balance sheet or hiding stuff off balance sheet. But there's going to have to be bailouts. And I don't think the policymakers here in DC, I don't think they will allow real deflation for a long period of time.
No, they can't. And one of the things I learned early in my career from Jim Blanchard was that central bankers are raised from their mother's breast to abhor deflation, and they'll do anything to avoid it. The lessons of the Great Depression are the biggest motivating factor for central bankers, and they will just unleash the floodgates of monetary accommodation to avoid it, whatever's necessary. And we see those examples in action. Another slide that I feature in my presentations shows the federal funds rate, the Fed funds rate, going back to the early 1980s, when Paul Volcker started to lower rates after he had killed off inflation in the US. Now, at that point, lowering rates was normalizing rates, but he started to lower rates, and at some point, they ran into a recession, and they had to. They would try, after they would lower rates, they would try to raise rates back again. And when they tried to raise rates, they would run into a brick wall. The economy would slow down, and they would lower rates again. Now, there's a 40-some-odd year trend. If you put a line under the bottom of each rate cutting cycle, you see a clear staircase down onto the basement of zero interest rates in the 2008 great financial crisis. Now, that crisis was so great that they had to do more than just lower interest rates. I mean, lowering interest rates to zero was already pretty dramatic, but they came up with quantitative easing and a lot of other fiscal programs and acronyms to rescue, in that case, the financial system, the banking system, and Wall Street. So that everything they did then was, or a bunch of the things they did then were unprecedented and really crazy. Then came COVID, and everything they did post 2008, they did much more quickly and to a much greater degree. When we have the next crisis, when we have the next recession, what they will do at that point, because they're going to have to do so much more to get the same effect, it's really going to be amazing, and it will be a even more explosive reaction in the asset classes, not just gold and silver, which would be the obvious ones, but because again everything is floated on a sea of central bank liquidity. When the Fed comes in with these extraordinary policy measures in the next crisis, we're also going to see real estate and the stock market and bonds and everything else respond. It's kind of a unity investing. Everything moves in unison now because it all depends on central bank liquidity.
And governments cannot tax deflation, so they hate deflation. Then, if people have savings and they don't have a lot of debt or no debt, deflation is fine. It gives you opportunity to go and buy a business or buy assets at a cheaper price. But I went and looked up the Fed's official balance sheet prior to the 2008 financial crisis. It was around 800 billion. It had stayed there for many, many years. They had hardly increased it. And now here we are. I think it got up to around 9 trillion. It's down substantially, a little over $1 trillion. But during the next crisis, Brien, it's going to have to expand significantly. We've just talked about the problems with commercial real estate, the regional banks. The Fed, they were talking in 2020, they only bought a small amount, but they wanted the rules changed so they could go buy junk bonds and commercial debt for corporations.
Yeah, and if you look at the correlation between Fed assets, the Fed balance sheet, against the S&P 500, the correlation is into the mid 90s as far as percentage correlation, and that's the effect of it. They bring in this liquidity, and that pumps up financial assets. It's not only the stock market but also real estate, and of course, as they lower rates, the bond market rises as well. So it is the way to maintain the economy in the modern era that they think they can. But again, this is a trend, and we've already hit zero, so they have to come up with more and more things to try and pump this money in. Every one of these steps, however, weakens and depreciates the dollar. And because every other nation is doing it and in the same boat, it also weakens their currencies. But because these currencies aren't strengthening or weakening against each other, again, they're all racing in tandem, in unison to the bottom of the hill. There's this impression that they aren't being cheapened. But again, they are against things like gold, against real assets. And a lot of
oil.
that, of course, is being revealed in the CPI.
Yeah, food, oil, all these copper prices, all these things, any of the real stuff that the Fed cannot print.
Yeah, and the Fed, actually, the government policies are exacerbating it in so many different ways. You look at all of these clean energy initiatives, what that is going to do for so many commodities, in particular copper, is going to be absolutely amazing. Copper is facing supply deficits just on the base case supply-demand scenario, and is facing tremendous supply constraints going forward. Yet it's also has to face, or will be facing, what may be the steepest demand growth curve that we've seen of any commodity. And that certainly isn't going to help inflation.
So I want to transition now to gold stocks, and your newsletter has been covering them longer and more in depth, I would argue, than almost anyone else for a very long time. I interviewed Rick Rule a couple weeks ago. He said that this disconnect or divergence between the gold price and gold stock valuations, he's only seen this once or twice in his 40-plus year career. Ross Beatty also said something similar at a Vancouver Resource Investment Conference recently too. Do you agree with them, or do you think that this disconnect divergence is pretty normal?
No, I agree with them. The valuation of mining stocks in relation to the precious metals may be the greatest we've ever seen. Now, I have seen the mining stock market as depressed as it is now in around 2000, 1999, 2000. But back then, gold was trading for $252 an ounce at the bottom and at multi-year lows. And it took a while. It took gold a couple of years of very significant price gains, nearly doubling in price before the mining stock market really started to respond. Now we have gold at record highs by a considerable margin and on a significant uptrend, and the mining stocks are only starting to respond. I think we're at a point where they are really going to start taking off once generalist investors realize that these already healthy margins, and a lot of the mining stocks, some of them actually didn't have healthy margins, but a lot of them did. And regardless, we've added over $100 in per ounce in margin in a matter of 2-3 weeks to these miners. And I think the generalists are going to notice that in fairly short order. A lot of people don't realize it, and you see people still in the sector, gold bugs and gold bulls, bemoaning the fact that the miners haven't yet responded to gold. But in fact, they have. They have been leveraging this move, this 3-week-old or so move in gold. The mining stocks have been leveraging those gains since the beginning. Perhaps not as much as we would like, but they have been providing leverage. They have been outperforming gold itself. Importantly, silver has done the same. Silver has about doubled the gains in gold since early March or late February. And also importantly, silver's outperformance has accelerated in recent days. And that and the mining stock outperformance are hallmarks of a secular bull market in gold. So everything's falling into place right now. And in fact, gold had gotten ahead of itself a bit, was dramatically overbought, and is kind of working that off as we speak. The days just ahead are going to be very interesting for gold and silver and mining stocks. But I think we've begun what's going to be a very significant bull market in the metals and the mining stocks. And I think this is going to be a great year for both.
So you mentioned the generalist investors need to get interested in these companies. We had one, and he's arguably the greatest hedge fund manager with the best returns over the last 3 or 4 decades, Stanley Druckenmiller. He took his profits on NVIDIA and these artificial intelligence stocks. I believe he was in them in 2020 and 2021. He was doing public interviews, talking them up. He's cashed out of those, and he's rotated into gold mining stocks. I also think that a lot of these mining stock analysts at the investment banks, they need to see a couple quarters of good free cash flow numbers, cash flow projections when they start to raise like the price targets and the cash flow projections for some of these miners. And that will start to interest more of the generalist investors, like you said.
Yeah, I agree. You can't dispute, you can't argue with bottom line earnings. And we're going to see that very soon from these big miners. And it's a process. There's still a lot of competition for speculative money out there in the Magnificent Seven or 5 or 3 or whatever it is, and NVIDIA and crypto and everything else. But we don't need to have all these generalist investors switch over to gold and silver and mining stocks. The amount of money that is out there in these other sectors absolutely dwarfs the entire metals and mining sector. So we just need a very small fraction of allocation shifts toward the metals, toward the mining stocks to get an absolutely explosive reaction. And I think that's coming, but it is a process. We're just seeing the beginnings of this new trend.
And you were just at PDAC in Toronto a couple of weeks ago. Do you think that these mining stock exchange traded funds, do you think that they're bad for funding a lot of these small and mid-tier miners and juniors? Because I remember when I first got into gold and gold stocks around 2008, 2009, there was a lot of Canadian investment banks, merchant banks before a lot of these mining stock ETFs, and they used to help fund these juniors for private placements so they can go do drilling. And it seems that over the last 10 years, those merchant banks and stuff are gone, and they've been replaced with mining stock ETFs. So there's not as much funding available for juniors and for miners anymore.
No, there is not, but that's in a different level too. The GDX and the GDXJ, those funds, those ETFs are comprised of relatively large producers, and those were not really the outfits that were being funded by the merchant banks. That said, there are fewer of those merchant banks out there right now. The market has changed. Now, all of this said, again, we have new funds. We have Druckenmiller coming in. We have another $1 billion fund that was just created that are launched that are coming in to the sector. So it's going to be it's going to change, but I think money will find its way here. I don't think the big money is going to be satisfied with investing in GDX or GDXJ, which in a typical bull market would quadruple in value. Whereas funds that are invested a little further down the food chain can do much, much better if they pick the right stocks. And there's no shortage of human hubris. And these money managers will always feel that they will be able to outperform those the major indices by doing their legwork. And in fact, they should be able to.
And the royalty and streaming companies back in 2008, 2009, they were small and considered niche. Franco-Nevada, I think their market cap was only around $2 billion back then when they started doing a bunch of deals. Those companies like Franco-Nevada, Wheaton Precious Metals, Royal Gold, they've done a bunch of gold or silver byproduct deals on these base metal mines, copper miners, which are direly needed. So they bought the byproduct streams. Do you think then that those guys are going to help provide financing then to the juniors and smaller producers to help build new mines?
Yeah, that's a good point. There are a lot more royalty companies out there. Now, a company will have to, or junior mining company or development company will have to sacrifice something to the royalty companies to get that financing. But again, they always have to sacrifice something, whether their financing is through debt or equity or royalties. So that is a new avenue, and it's not necessarily a cheap avenue for the royalty companies because there are so many royalty companies out there. They have to bid against each other for these new financings. So the upshot of that is a corollary to that is that these kinds of financings can be ever cheaper, less expensive for the mining companies. So that is a new source of funding or a greatly expanded source of funding that's available these days that wasn't necessarily available years ago.
Yeah, I think the royalty and streaming companies, I think they're a free market. They fill the void because of the mining stock ETFs and then the merchant banks leaving. So Franco-Nevada and some of the larger ones and then the mid-tier ones, they just had the opportunity to do a bunch of deals that they never would have been able to do in the past because there was funding for the juniors and the smaller producers from other sources. But as the funding went away with the merchant banks and the mining stock ETFs, the royalty and streaming companies have filled the void. So I would say it's like a free market solution. Now, the cost of capital, like you said, is higher, but the royalty and streaming companies, I would say they're willing to do more creative financing or amend a royalty or stream if it means the mine's not economic anymore.
Yeah, money will find the sector. And of course, this kind of thing accelerates and feeds on itself as more deals are done, as the sector rises. As more returns are made, they are plowed right back into the market. And this works at every level, from retail, up to institutional. As money is made, as the good times return, it gets plowed back, and money is much more easily found. We saw that in the early 2000s. Actually from 2000 to 2011, in that long-standing bull market, there were fortunes made as stocks multiplied in price, and then positions were rolled back into the market into other positions that multiplied in price. So very quickly, we see that wealth can be built up in that kind of a market. And a big part of it is the fact that the rising tide is lifting all boats, even the losers. So if your losers are not falling in price, if your losers are actually increasing in price, then that dramatically enhances the kinds of returns you get from a portfolio.
Do you think at the current gold prices, we're going to see a lot of new mines under construction, or our cost of capital with interest rates and capital is competing against what short-term treasuries or Bitcoin or tech stocks, that there's not going to be that much capital to build new gold mines going forward?
A rising metals price cures all evils, and I think that's going to be the key. I think you're going to see a lot more exploration done. Finally, we're going through kind of a drought of exploration expense. You're going to see majors getting more aggressive on M&A. You're going to see majors more aggressive on joint ventures or juniors. You're going to see a lot more money going in to find discoveries as the gold price continues to rise. So the cost of capital will fluctuate. If the Fed ends up lowering rates, then to some degree the cost of capital will decrease. But you also will have more players coming into the sector and more competition for financings. And so I don't think you'll see it increase over much. A big impact, as it always is in the mining sector, will be the cost of energy and construction. And we've seen that over the last couple of years start to compress producer margins. That will also be a big effect going forward. But I think at least for a while, we're going to see the rise in metals prices outpace those other costs.
Yeah, I would agree. We have to see higher gold prices, maybe gold at between 2,300 and 2,500 before a lot more new mines start to get funded. Right now, people are really skeptical about the gold price rise, especially Western investors, the Keynesians, the hedge fund managers, the people on Wall Street. They're not optimistic that gold price is headed to 2,500 or 3,000 an ounce in the next 6 to 12 months. They're just not optimistic, so they're not willing to fund these deals. And that's why you're seeing some of these really good gold mine projects, whether it's Windfall in Quebec, they had to go, Osisko Mining had to get a partner. They had to get Goldfields, when in the past that project would have been funded on its own.
Yeah, and a $2,500 gold price not that long ago, you'd lose a good bit of credibility if you predicted that when a mainstream financial reporter would ask for your opinion. And I've actually been in that situation where I resisted saying that because I didn't want to look like I was a tinfoil hat wearing gold bug. But a $2,500 gold price still seems kind of high, but that's only about 12-15% above where we are right now. Gold could do that in a month. It could do that in a few trading sessions, frankly. So we're not that far away from these numbers that just seemed absolutely fantastic not so long ago. It's a new world right now. It's a new world. And if you look at the performance of gold in the 2000s, it really was not unusual to see the gold price go up 20% in a year. If we do that now, we're getting ready to knock on the door of $3,000 gold.
Let me provide a little counterexample then for that. I mean, the last 3 years, 3 to 5 years during the pandemic, especially over a 2-year period, I mean, the government's, not just the US, they created trillions of dollars of new money supply. So that's a lot of monetary inflation. And I would argue the gold price has not kept pace with the consumer price index. So if the gold price is the US dollar gold price is going to keep pace with the consumer price index, should be around 2,500 now.
Yeah. Well, if you look at the price of, constant dollar price of gold, I think we're at like $3,600 to match the $850 price peak of 1980. And we're at $2,400 or thereabouts, just to match the price peak of August 2020. So yeah, we are in rarefied air, but very normal market reactions in this kind of a macroeconomic environment will get us to those levels in the mid 2000s very quickly.
Except that the generalist money managers, so the Keynesians, the people on Wall Street that manage a lot of money, they're not gold bugs. They're like, deflation's coming and inflation's going to cool off, not inflation's coming in waves. And they're like, a lot of these guys are short gold. So a lot of these guys are not just short gold, they're short a lot of other commodities too, although they've been wrong the last couple of months with the rally in copper.
Well, higher prices are a solution, again, to a lot of things, and it will absolutely send the shorts running. I don't know that, given the performance of gold, it takes a certain degree of boldness, if not stupidity, to be heavily short gold at this point.
There's a lot of Keynesian hedge fund managers that are short gold. I mean, I think they're going to be eating crow and humble pie soon, but we'll see. Or maybe they'll just lie that they'll deny that they were short gold. I want to get your thoughts, though, on investing in certain countries for mining. Do you think any of these, the geopolitical risks, say in Mexico or some of these other countries, is changed drastically and you're staying away from, say, investing in mines in Mexico now?
I don't think Mexico's as bad as some people fear. We do watch the politics down there fairly closely. You're going to have risk everywhere. You're going to have geopolitical risk everywhere, and even in the U.S. And every deposit or every company has to be judged against that risk. There are some far-flung areas and much riskier regimes where it will take, in my view, a much better deposit or target to adjust for that level of risk. So it's always a spectrum. And if you're going to go into, say, Ethiopia or Niger, some places like that, you're going to have the size of the prize has to be commensurate with that added amount of risk. You can it's a big world and lots of opportunities and lots of risks. You can focus your portfolio just on North America, but you will still face some geopolitical risk there as well. We have focused in recent years on North America, including Mexico. I think your bar for Mexico is probably risen a little bit, but not over much. We are now recommending some companies, some projects in Ethiopia for one, but the size of the prize makes it worth it in my view. So it's always a balance, a risk reward judgment that you have to make. And I would not, in any case, have all of my eggs in any single basket either.
Yeah, the mining companies have made some of these mistakes lately, although Mexico does have, I would argue, two of the best silver deposits. You have Mag Silver, Juancipio, and then you have Silvercrest, their mine. So if you want a high-grade silver project that's producing with good profit margins right now, that's your best choices in terms of like profit margins for low-cost silver mines.
Yeah, not much marginality there related to the silver price. I like Vizsla Silver in Mexico. It's just a tremendous deposit, a growing deposit, great management team, and by some measures, trading at 1/5 the level of their peers. So you have the potential of a rising silver price. You have the added potential of increasing the size of the resource, which I think it is obviously going to do. And then you have, as it advances the project along the development curve, a re-rating more commensurate to other resources and other companies in its peer group. So that's one that I like, now that we're talking silver companies in Mexico.
In terms of mergers and acquisitions in the sector, Newmont Mining did the largest acquisition. Now, their costs have risen a lot more than they anticipated. And I think they're doing asset sales to kind of pay down debt and fix their balance sheet and get rid of some of the higher cost mines. Do you expect that the senior miners or the larger mid-tier ones, are they going to be doing more mergers and acquisitions? Or are they worried now about how things have backfired with Newmont?
It's hard to say. I mean, it's all on an individual basis. I think Barrick has become uh, interestingly or surprisingly aggressive in some ways, particularly in copper. So yeah, I think we will have more, not so much amongst each other, because I think there's a perceived competition now amongst each other. But for majors acquiring mid tiers, perhaps, and mid tiers acquiring projects from the junior sector, but we haven't seen. We've seen a consolidation at the top of the mining market that I think is going to evolve over time to where we have new majors arising from the mid-tier level, and uh, smaller companies becoming mid-tier companies. Because when you have mergers like this, you have projects that fall out of the hopper that, because of different management priorities, you have great projects that are simply thrown onto the market, and smart people pick those up. I think we're going to see that come out of the Newmont Newcrest merger in particular.
That's really interesting. Yeah, it depends on the price that it's sold for and what the acquirer buys it at. We're also seeing like these massive mines like Greenstone. I mean, Equinox Gold, they have some higher cost mines in their portfolio right now that some of them aren't even generating free cash flow. But if Greenstone comes online over the next couple months, and then it what produces enormous free cash flow over the next couple years, it's going to solve a lot of their problems. And then maybe they could sell off an asset or two after that.
Yeah, and one of the things you look at, especially in a rising gold environment, are the worst mines often do the best. In that the highest cost producers, the marginal producers, the ones that are barely making money or just breaking even, their earnings rise at a much greater rate than the high margin producers as the gold price rises. So you get much more torque by investing in those mines. Ironically, that the worst mines can be your best investment on the cusp of a major uptrend in the gold price.
But those companies aren't buy and hold though, right? So those companies, that sounds like a trade to me where you time it right and then the gold price goes up and the mine that was like either barely break even or losing money all of a sudden becomes profitable, and then you make a profit on your trade and then you cash out rather than buying and holding.
Yeah, it's dependent upon the gold trend of the gold price. If the gold price is still rising, their torque relative to the higher margin producers will remain in place. It will still be on a percentage basis, that torque will decrease over time. So yeah, it is depending on your definition of a trade. These days, a trade is measured in minutes as opposed to months. But that is the kind of a play that if you're going to do it and it's in a rising gold price environment, I think it is measured in months and not years.
Yeah, what worries me the most, and I think a lot of the mining companies did this enormously from 2011 to 2019, was the amount of high grading at the deposit. So if gold prices keep going higher, I think you're going to start to see a lot of these miners that had the worst grade ore stockpile. They're going to start to throw that in the mill. So they're not going to be disciplined to maintain their profit margins and focus on free cash flow. So hopefully there's more discipline on profit margins and free cash flow from these producing miners going forward.
Yeah, we can only hope. But again, human nature shows that we shouldn't pin our hopes on that.
Well, that's why I buy royalty companies.
Yeah,
so I don't have to. So I don't have to worry about an extra capex bill building a new mine. I don't have to worry about those types of things. Or all of a sudden, the all-in sustaining cost metric like Pan American Silver just goes, because you've been in this longer than me. I mean, Pan American Silver was the lowest cost producer for decades, right?
Yeah, well, I remember when Pan American Silver was just a silver optionality play. So yeah, I go back a ways. Things do change, and of course, you look at SSR. It started out at the same time as Pan American Silver as a silver optionality play, evolved into a gold production play, and a fairly good one too. It actually had more leverage for some reason than its peer group. And then you have something that happens, like the dam failure in Turkey, and see what happens. So it is a risky area, and you need to diversify.
Yeah, I agree. SSR, that's just really sad. I mean, things looked really good for them until the accident at the mine. And now, like, they've gone into full cash conservation mode. On their last conference call, they're not talking about growth. There was a dividend cut, share buybacks were cut. I mean, these are all things that are red flags to anyone that was buying and holding the stock and hoping for a quick solution. It's just not looking good. There's too much uncertainty there right now, and they're not talking about growth.
That's right. So things happen.
Well, I really enjoyed our discussion. I feel like I could talk to you over some beers about mining stocks for another couple hours.
Well, I wish I had the time for that, and I wish I had the beers, but I have neither right now.
Maybe I should come down to New Orleans on Bourbon Street. I did enjoy my one visit there.
Well, come down to the conference this year. This is our 50th anniversary event. So it's November 20th to 23rd, and it's, all the cool kids are coming. So it's going to be great.
And if my listeners want to check out your newsletter, how did they do so?
Goldnewsletter.com. The original and the longest running newsletter in the business. And they can find out about the New Orleans conference, which was and is the longest running investment event in the world today. And they can find out all the information on that at neworleansconference.com.
Congratulations on the conference. I mean, that's probably the top conference. All my friends who are big name speakers like Danielle DiMartino Booth and others, that's the one they want to go to.
Yeah, and those speakers tell me that it's their favorite event of the year too, because again, it's where they all get together. It's kind of a gathering of eagles, a gathering of the most insightful commentators in the markets out there, and they all hang out and have fun. And importantly, they hang out with the attendees. It's really a unique event. There's nothing else out there. Everybody comes down into New Orleans, which is a fun destination. We have very few locals that come to the event, so everybody's in a place where they're having fun, and they're with people who, if not exactly like-minded, there are people who are very successful investors and are independent thinkers. And we share ideas. They get to mingle with some of these big name speakers. They get to mingle with other very successful investors and have a great time and great discussions and great discoveries.
Yeah, I like New Orleans. Some of the best food of any city. It's a great city in the United States.
I can't argue with you there.